Hello and good afternoon to you all. Thanks for joining us in this webinar. Today we'll talk about hyper-customized equity investing, a unique fund for each investor. My name is Swapnil Pawar. I'm the founder of ASQI Advisors, the platform behind MakeMyFund. To keep our session interactive, we will try and take questions even during the session, not only at the end. So feel free to type in your questions in the chat window on the right-hand side bottom. And some of these questions which are pertinent to that specific topic will get moderated and we'll talk about it during the session. The remaining ones will take up at the end. So without further ado, let me just dive in. Mutual fund investments in India have come a long way. I remember starting advising clients back in 2006 when it was a fringe product, to say the least. And investors thought of mutual funds as equity market, which itself was actually relatively new to a lot of investors. So since then, mutual funds have come a long way, and now they are fairly mainstream, if you will. The Indian investor now is sophisticated enough to understand the nuances of fees, cost, outperformance, alpha, and so on, and hence take it to the next level where they actually look for something more beyond mutual funds from their investing portfolios. It's with that intent that we thought of doing some research on the global trends in this domain. And a couple of the trends are actually very relevant. We'll talk about them using live examples in the Indian context and Indian investors, if you will. So going right in the first slide, we talk about, say, this mid-aged corporate executive called Smita. Her predicament is that, so she's settled in India, say Mumbai or Delhi, figuring out her investing options as she goes along. Now, let's say a lot of her batchmates or her colleagues, ex-colleagues are settled in US now, and every time she speaks to them about investing options, she realizes that not many of them, almost none of them, invest in mutual funds anymore. The question is, where do they invest then? So some of the dialogues from these conversations would go along the following lines. I prefer ETFs since they charge less than 1/4 the fees of mutual funds. I get so many options in ETFs. There are some ETFs for all. There is some or other ETF for almost every conceivable investment theme, including leverage for that matter, or innovations, technology disruptors, and so on and so forth. Now, it's an interesting phenomena which has taken place in the West over the last 10 years. It'd be interesting to notice that in 2019 September, the AUM of actively managed funds in the US was lower than the AUM of passively managed funds. That's the first time it crossed, in fact. And this is not a one-off year. It is a trend for last 10 years that each of the 9 out of 10 years in 2010 to 20, actively managed funds actually have lost AUM in the US, and passively managed funds have gained AUM in the US. So the trigger for this has been essentially two realizations by investors. One, mutual fund outperformance of actively managed strategies is very hard to sustain, and it's already eroded in the US and the West in general. And secondly, the fees is a very important component of long-term performance of your portfolio. So ETFs with their fees of 0.1, or in fact, one of them actually has zero fee, the index fund. One of the index funds has zero fees. And others are 10 basis points, 20 basis points, 30 basis points versus 2% for mutual funds. There is obviously a trade-off there. Now, Smita wonders if she can do this in India too. Seems like a logical thing. But there aren't too many ETFs in India. Two reasons. One, structurally, Indian markets are small, so you can't create too many ETFs which will all be of a decent size. Secondly, the selling process of funds has been more push than pull. So ETFs don't pay commissions. So you're not going to see ETFs coming from many advisors, especially the ones who are not fee-based. So that's the first predicament of Indian investor who's achieved some degree of sophistication, that thematic investing or investing in a specific idea rather than a general actively managed fund is very hard in India. Moving forward, the second type of investor is, let's say, not a savvy investor, but someone who has a good amount of money to invest and is saving through various a combination of insurance, SIPs, and so on and so forth, right? So this is Dr. Gupta, who's looking to send his daughter to US for studying economics in, say, 6 years, 7 years. Now, he's saving regularly for this using various combinations of instruments. The question is worried that the exchange rate of US INR, what will it be when 6 years later he needs to send his daughter to US? It could be 150, it could be just 90, it could be 180 also. He doesn't know, he doesn't have control over it. And depending on what the exchange rate turns out, his corpus could fall easily 20-30% short of what he needs to build or what he needs to have to spend without any real fault of his, because he would have targeted a certain number considering today's exchange rate. So he wants to ensure that this education fund is hedged against the USD INR currency risk. And it's not an easy one, if you ask me. Now, let's look at a third trend, which is much more common in the Europe or EU rather than US, which is essentially environmentally aware or ESG aware investing. About half of the investments in Europe, institutional investments in Europe, are actually mandated to follow a ESG approach. Now, think of someone like Anubhav, who's our candidate for ESG investing here. He feels, let's say he's an IT executive who's basically 30 years old, trying to do his bit for environment and healthy living. He feels very strongly about these causes, and he's contributed where he can to these causes through money, efforts, time, etc. He wants to make sure that his equity portfolio also reflects his values. For example, if he feels so strongly about environment, he wants his portfolio not to have any fossil fuel polluters, if you will, or have higher weightage to renewable energy, lesser weightage to sugary drinks, and so on. Could be whatever ethical considerations. We're not saying what they are right or wrong. All we're saying is there a way to actually reflect that in your portfolio? And he also is looking for some options in Indian context, whether he can do it. All he can see is a couple of ESG funds, and then rest of it is simply your good old mutual funds. Let me see if there are any Q&A here. No. So now the question is, can this be served by the Indian mutual funds, the Indian asset management industry, the mutual fund industry? Our short answer is none of them can be served well by mutual funds. They can be served, but to a very limited extent. These are the 4 reasons. First is most of mutual funds are push products with no customization. So like they say, man proposes, God disposes. So in that similar way, AMC designs, advisors sell. That's pretty much the end of it. You can essentially take it or leave it as an investor. You don't have an option of saying, I don't want this, I don't want that. Could you customize it in this form or that form? One size is supposed to fit all. Second thing, which is far more worrisome for even people concerned about only returns, is high cost and poor returns. You would have seen in the last 10 years, the index has done about 10 to 12%. And most of the mutual funds, large cap mutual funds in particular, have either done just about at par or worse, especially when the total return index became the norm, which is obviously a logical thing to do. The performance of mutual funds has started to look just about at par with benchmark. And this is not surprising, because the efficient market hypothesis states that on an average, you can't outperform the market, because collectively all of us are the market. So if an average mutual fund does at par with benchmark pre-cost, post-cost of about 2%, it is obviously going to look pretty poor. What is changed in the Indian context is this. 10 years ago, we did this analysis back in 2009, thereabouts. 12 years ago, I did this analysis, and I found out, unlike the West, Indian mutual funds perform better than benchmark, consistently so. But they don't anymore. What's changed is the size. Back then, the mutual fund scheme used to be 500 crores, 1,000 crores, thereabouts. Now it is of the order of 10,000 crores. If you're a 10,000 crore mutual fund scheme, you're not going to be able to outperform the benchmark by just picking a few good stocks. You're just too big to outperform. And that's just structurally how the industry evolves. So going forward, I'm not going to hold my breath about my large cap mutual fund outperforming the benchmark. I'm expecting it to do at par with benchmark at most. So then, and the returns have started to come down at the benchmark level itself. We used to think back in 2010, 15% was the norm for equity forecast. Now it's more like 10, 12%. Maybe it will pick up in future, but there's no guarantee. Last 10 years, we have seen only about 12%, despite the recent pickup. Now, if that's the case, then essentially you're talking about a gross return of 10 to 12%, a fees of 2%, you're essentially left with 8 to 10% net of fees. In this case, a fees saving of 1.5% or even 2% can make a dramatic difference taken over a 5 to 10 year window. So that's the high cost, poor return logic. The goal-based investing in Indian context has, in fact, even globally, but Indian context all the more so, has received fairly poor product options. We've seen a bunch of insurance products, which are meant for retirement and children's education and so on, but all of them boil down to the same thing, that it's SIP in some form or other. What the money goes into is not customized to the goal. It simply is assume that one type of equity is good for everyone, and then at best you might do some asset allocation saying equity versus debt is this, but you don't make your portfolio reflect your needs in a goal-based investing. We'll see some examples of how we do that. So there's no real goal-based investing in the Indian context. Lastly, and this is an important emerging area of interest for a lot of people, there is no room for ethical considerations. For example, if you're, there are a few Sharia compliant funds, for example, but they're just few and far between. If you, for example, are a vegetarian or you are abhor non-vegetarian foods and sort of killing for meat and so on, or you're a strong proponent of social impact investing and you want to avoid some companies and invest more in some companies, there is not that much room to do that in the mutual fund context. So that's sort of a background to what we are trying to see today as to where we are stepping in to make this customizable, low cost, and towards the end we'll talk briefly about tax saving as well. So I want to leave this one number with all of you. We want to perform better than mutual funds by about 3 to 5 percentage points each year. What that means is, of the 3 to 5 percentage points, we'll receive 1 to 1.5 percentage points from better performance of the underlying strategies. Second is 1 to 1.5% from lower fees. We want to charge 0.25% instead of the 2% of mutual funds. And we want to get about tax saving of 1 to 2%. Put together, we want to push the 10 to 11% returns of large cap mutual funds in our system all the way to about 13 to 15% at the very least. And this is at the gross level, and then customization is sort of an added bonus on top of that. So that's, I guess, the broad thought process behind MakeMyFund. I'll stop the presentation here and take you to the screen where I'll walk you through how that works in practice. So we call it personalized virtual equity fund. We've been told to simplify the name. So this essentially is meant to be both personalized and virtual. The reason behind personalized is, as I explained, that each fund, if you have 10,000 investors, we'll have 10,000 funds. It's virtual in the sense that it's not a conventional mutual fund where it's a unit and then there's a NAV and so on, but it's actually a virtual fund with individual stocks sitting in your demat, which you purchase through our system or sell through our system. We'll see how. So we do customization along these 4 directions. One for highest returns, which is essentially we're talking about Smita's predicament earlier, the smart beta ideas, my ethics, which is Anubhav's options, ESG, Sharia, innovation, so on. My goals, which is Mr. Gupta's plan, and my themes, which is part of what Smita's predicament was as well. So I'll walk you through one of these in detail and the rest at a higher level. Obviously, we'll be doing more webinars in the future, which will talk specifically about each of them. But at this stage, let me just go through this one first. So we talk of highest returns. You would have heard about the whole logic of value investing, quality investing, good and clean companies, so on and so forth. These are some of the popular factors globally and India as well, which even mutual fund managers use while designing their portfolios. So we are now making it available to a wider audience without having to pay that much fees and making it very transparent. So when we say quality, we tell you what quality is. Companies with high return on equity, higher cash proportion to their quality of earnings. Value, already most of you would know, is price to earnings ratio or price to book ratio coupled with some measure of growth. Dividend yield is straightforward. Trading activity is also straightforward. Low vol is to do with the price and earnings volatility. What's customizable here is you can actually say, I don't want anything other than quality, and just say, design me a quality portfolio. Or I want a combination of quality and value, but I don't care about dividend yield, maybe some trading activity, but leave the small amount of low vol. So all of this is up to you, how you customize. This is the customization of factors. Second is customization of the universe itself. There is a high level customization, and then there is a in-depth customization. The high level customization is you choose the universe, which is top 200, blue chip 100, mid cap, which is 101 to 500, or multi cap, which is all of top 500. Or you can actually choose a specific and secondly, you can choose a portfolio size. So if you have a 1 crore investment plan, then it's better to stick to a large portfolio of 100 stocks or so. If it's a very small portfolio, 25 probably is a good number. Less than 25 doesn't make sense because it's not diversified enough, but something in between is good. Let's say we stick with 500 here. What we take pride in is ability to specifically refine the universe at the next level also, which is exclude specific sector, business houses, or companies. For example, you may say that, look, last few years services has been laggard. All these logistics, realty, media, aviation has not done too well. So let me just take that out. So we deselected it. And inside commodities, specifically, I don't like sort of iron and steel, or all metals for that matter, mining. But I'm okay with crude oil and gas. So that's one type of exclusion. So one level or second level, you can exclude a company or its, a high level industry or its sectors. You can exclude a business house saying, I don't think Thappers are doing a good job. So I want to exclude all Thapper group companies, even if at all they happen to be in that universe. And you can exclude a company, any number of companies, any number of business houses. Let's say you say Torrent Power is not my favorite company. For whatever reasons, I don't like it. Just to be clear, these reasons for exclusion could be positive and negative. So for example, if you happen to be working at M&M, Mahindra & Mahindra Group in some form or other, some company or other, you happen to have a lot of ESOPs from one of the Mahindra Group companies and you're exposed to it significantly, you can exclude that company. Or you're at a group level, so you are a holdco exposure, you can exclude the business house. Or you have a lot of TCS or IT company ESOPs, then you can exclude IT as a sector. So this could be for good reasons or bad. So either way, you save your selection, you get back to your original screen, and now the third step is to check how this portfolio would have done in the history, right? And as we see here, just to be clear, the simulation took 2 seconds, which most of the conventional quant algorithms would take about 15 minutes to run. Part of the reason we've spent a lot of time building this intellectual property is being able to do things like this, quick simulations and so on. Nevertheless, we see here it's a 16.7% per annum portfolio, 2007 to now. 12.3 was the benchmark. The benchmark was designed according to what we select here in the top 200 versus the blue chip is different benchmark and so on. Now, you see even a short term, the performance has been actually quite good. And 3 year, 1 year, so on. You can check YY returns here, general performance metrics. Next is, we don't want to just tell you that this is the performance of the portfolio. We'll tell you what is the portfolio today if you were to invest in it. So this is the industry-wide allocation of the portfolio. Here's the specific companies in this portfolio that I selected and constructed. But this is still an indicative portfolio because we're talking about percent terms. We are not talking about number of stocks. For that, we go to the next step. But let's say after seeing this, you still want to modify a few things. You can go back to this optional variation in universe, add back the companies you removed or sectors you removed. It's an optional check. This is the portfolio repeated from the previous one. But if you change it here, then this changes again. So whatever your portfolio finalization is, after iteration, you go to the next step. At this step, if you're already registered or already logged in, then this won't come up, but I'm starting for the first time for your benefit. So you can log in using your Google ID as well, or create a new account. In this case, I'm creating a demo portfolio. So just to be clear, this I'm calling it demo, but this is a live portfolio and it's going to execution live, like right now. And I'm glad that NSE is operating today and it's not down. So there are 3 options here. You can download the CSV and say, I'll execute with my broker separately. Trade means you'll execute with your broker, but through our gateway. So you don't need to open a new broking account for this. Or you can just go to the dashboard and it becomes a paper portfolio. In this case, I'm choosing it to be a live portfolio. So there are 10 brokers you can choose from: Zerodha, HDFC, Angel, Kotak. There's 2 more here. Edelweiss. So in my case, I'm choosing Zerodha. I go to, this is my actual account, as in Swapnil Pawar's account. I'm logging into my Zerodha account. So that the gateway then has taken me to a live execution window. This is some 7,900 rupee portfolio. It's a demo portfolio of 8,000 or so. So this is rounding. After rounding, it is this number. I can say I don't want two. I can modify at this stage also, saying I don't want 2 stocks of Castrol. I want only 1, or I want to have 1 more of Colpan, or not. And then I review the orders. When I place orders, this will actually get bought into my Demat account through Zerodha. So this is happening live. We are actually sending these orders actually to NSE today. All the orders have been filled. After a couple of seconds, I'll go back to, yeah. So trade successfully executed. You'll be taken to dashboard, which means these are my various portfolios I created. Some of them are paper, some of them are live. The demo 1, 2, 3 we created just now. You see this 7,823 rupees invested. The other stocks. So demo portfolio is a small portfolio. This is status live as against paper. The mandate we went through was highest returns. It could be ethics, could be my goals, etc. Inception date today. There will be no returns because we haven't yet started. This is just created today. So after tomorrow, day after, I'll start seeing returns also, or this graph also will show up. And so that's the current portfolio. My other portfolio is also visible here through this combination. So that's in a nutshell how a portfolio view would be: individual portfolio and collective portfolios. And this will be rebalanced every so often. So every 3 months it will get rebalanced. So you will need to execute the rebalanced trades again then. Now, others I won't go through the full flow, but just to clarify, our 3 protagonists, which is Smita's case we handled just here. So Smita would now be able to do the highest returns portfolio similar to her friends in US. Instead of doing an ETF, she just does a specific theme or a specific smart beta factor like quality or value and so on. We'll keep adding to those in future as well. Now let's look at Mr. Gupta. His goal was to save for his children's education. We have here a multitude of goals: retirement, which we call personal inflation rate, education, marriage, house purchase, etc., etc. So in specific case of education, let's say this is 6 years hence, it's an overseas goal. We take some additional inputs to say, is there going to be a lot of spend on these 2 things? If yes, in this case, it's going to be high on flights, maybe. Again, you have the same choice. You can exclude a few sectors, add a few, exclude a few companies and so on, and then simulate this. The rest of the logic is similar. Likewise, when you go to themes, which is for a slightly savvier investor, again, back to Smita here, there are only 7 or 8 sector funds in India right now. So if you want to do banking ETF or banking fund, you have some options. You have some in FMCG, IT, and I think pharma. But if you want to do, say, cap goods, but only a subset of cap goods, or let's say you want to do only investments in insurance companies. So that's, you're essentially creating a sector ETF on the fly with the system. Or you can combine 2-3 sector ETFs if you wish. Any combination here. So you can do only textiles, or only FMCG, or only consumer durables. Likewise for services, you can do only realty, only education, so on and so forth. Likewise, there are themes. So themes are like a superset of sectors or some ideas. So discretionary consumption is one such theme. So if you go with that, you essentially get a set of factors. Now this you can customize further to say, look, I want discretionary consumption, but I don't agree with your definition of including, say, packaging in it, or something like airlines in it. Or I just don't like airlines, so I don't want to include them, or breweries. Then you go to next, you get a portfolio which is built with those caveats. So that's the themes portion. And last but not the least, the choice that we were trying to create for Anubhav, which is ethical investing. So let me just take stock of if there are any comments here. So before you go to ESG, there are two questions. Let me just answer both of them. How do you select equity? And second is, so let me first answer how do you select equity. We follow a logic of what we call tilt towards a factor. So when you create a quality portfolio, it is a long only portfolio, and it does cover the 200 stocks, top 200 stocks, let's say, if that's what you selected. Now, top 200 without any factor would have some weight allocation similar to index, which will be essentially market cap weighted. Now, we create a tilt based on quality. So high ROE companies will get higher allocation than their own allocation in the index. So if it's a mid-sized company, then its weight was 2% or 1%, it will become 1.5%, let's say. If it's already a large company like Infosys, which has 5% in the benchmark, then it will become 6 and 6.5%. A low ROE company, a large company like, say, Adani Ports, it has 4%, it will become 2.5%. And a small, poor ROE company, if it was 0.5%, it will become 0.3%. Some of these get rounded down to 0 and so on, but that's how we create the tilts. In the long run, then that performs better than the benchmark. This is a broad idea of smart beta. We'll do another webinar on smart beta itself in isolation. We'll talk more about it then. Second question is, how are qualitative factors such as news, company acquisitions, patents, etc., factor into portfolio creation models? So we have a few risk management algorithms running in addition to the main factors, which essentially limit the exposure to a specific company and so on. But beyond that, we do believe that if your rebalancing frequency is once in a quarter or so, these things such as company acquisitions, patents, etc., tend to get subsumed in the wider portfolio creation algorithm. So if you're creating a very small concentrated portfolio of 15 companies or 10 companies, then it makes sense to be very, very wary of company level news. If your portfolio has 50 stocks or 80 stocks, then each company's allocation is going to be closer to 2-3%, 4% at most, maybe more like 1%. So in that case, it doesn't affect you that much. And anyway, there is no clear way to play the news. We'd much rather focus on long-term investing approach than going by short-term triggers. So they tend to average out in the medium term. That's our observation based on actual empirical research. So let me then quickly go to the presentation again and take the next set of questions after this. So ethical investing in Indian context has been generally missing, to say the least. So we have 2-3 ESG funds, but they are opaque, meaning we have to just take the word of the managers to say, okay, this is environmentally friendly and so on. We want to make it more transparent and also say that we don't want to say it's an ESG strategy. It's E, S, G, and many more ethical considerations we'll see here. So, for example, if you don't believe that you care much about governance, you just want to say, I care about environment and social impact, but nothing else. So let's leave it out. Let's create a portfolio only of these. Or you may say, I don't believe in the whole environment angle. I'm a patriot, so I want to invest in industries which are going to make the country stronger. Or you're very passionate about health, such as Anubhav's case, where environment and health is high priority for him. So you can figure these out. These create tilts and exclusions in the portfolio. So if you're heavy on environment, then fossil fuels and coal, etc., would be a lower allocation, close to almost zero. If it's and then renewable energy will be higher and so on. If it's health focused, then fast food companies will be lower, cycles and other health oriented things would be higher. Besides these, there are these two religiously oriented ethical considerations we created, which essentially Sharia and Sattvic. So Sharia is the Sharia law, which stays away from alcohol, tobacco, interest earning companies like banks and NBFCs and so on. Second is Sattvic, which is what we call the Hindu equivalent of it, where meat production or processing is taken out, alcohol, tobacco, leather, other such industries are taken out. So there are two possibilities which are 1-0. They straight away exclude companies. Whereas in here we have tilts. So let's say we created this portfolio of health focus. Now when you create this, you get one level additional customization. You may not agree with our definition of what is environmentally damaging or not. So in this case, fertilizers, pesticides, and cigarettes turn out to be significant exclusions. So you may say, look, this is pesticides should be even more. Like, I don't want any portfolio, any allocation to these. Or you may say that there is too much hype about breweries and distilleries being negative, so let me just remove it. So that gone there. And some of the things you might additionally make it higher impact, for example, refineries brought up here. And then you create your portfolio. So there's a customization at each level possible, and universe selection and so on, which applies as earlier. So you can do it in the mid cap, large cap, multi cap, and so on. So that's the customization for my theme, my ethics, as we call it. So this is, in some sense, in a nutshell, that's the overall platform. You can create multiple portfolios. Each portfolio can sit either as a paper portfolio, which you have not transacted in, or a live portfolio like I showed in my own portfolio just now I created. A quick word about fee structure. Now, that's an important thing. We take a lot of pride in saying this, that since it is a technology-enabled solution, technology-enabled mass customization solution, we want to keep our fees to a rock bottom level. So we charge only 0.25% of portfolio value, capped at 1 lakh rupees. So if your portfolio of 1 lakh rupees, it is, or say 10 lakh rupees, your fees is just going to be about 2,500 rupees. Versus a mutual fund, which would charge you about 20,000 rupees for the same 10 lakh rupees fee. If your portfolio is 5 crores, on the other hand, your fees from mutual fund would be about 10 lakh. And if a direct plan, it will be still 5 lakh. We'll charge only 1 lakh. So that's one. Second thing is, so before I go to the last bit, let me just see if there are any other questions. So there is one here. How often is the portfolio database updated with new stocks or companies moving between industries? The portfolio database is updated every week, but we prompt portfolio rebalance only once a quarter for obvious reason that it leads to higher taxation and churn if we do it too often. So we have done the optimization to figure out what's the optimal level of churn. We realize that for long only portfolios of the sort that we are doing, it makes sense to keep the churn to quarterly or in some cases even annually. But quarterly is the update of the portfolio. There's another question. What is your value addition as mutual fund to selection stock? Well, so mutual funds don't really select stocks anymore. You can think of the two extreme approaches. One approach is to say that I'll select only 10 good stocks. Some companies do that, but they're not mutual funds. They're more like PMS providers or AIFs. And they'll perform great. These are generally mid-cap stocks. You can't select Reliance and Infosys and Tata Motors and deliver outperformance. So that's perfectly fine. So we believe that holds a lot of weight in terms of generating performance. But if you're a 10,000 crore HDFC top 200 sort of fund, you're not going to be able to select a stock and say, okay, I'm going to invest in 10 stocks. You have to select, you have to invest in index plus portfolio, which is our gripe. We are essentially saying that all large mutual funds are essentially index plus funds. They just tweak weights of companies in the index. They might exclude a company or two. They might be overweight some sector or other. But beyond that, they don't do a whole lot of stock selection, if you will. That's a different purview of mid-cap and small-cap managers. So if they're just essentially going to be overweight, underweight a few stocks in a few sectors, that is better done through a smart beta approach, which is what we are doing. Mutual funds also doing the same thing. They're just charging more for it. And that is reflecting in the performance. So when you see a performance of a typical strategy on our, a quality strategy, for example, on our platform, you see that in the last 10 years, it would have done almost 3 to 4 percentage points better than benchmark. Whereas a mutual fund, a typical large cap mutual fund, last 10 years has delivered just about half to 1%. One of the best of them have delivered 1 to 2% at most vis-a-vis the benchmark, which is lower than us. And the average one has actually underperformed the benchmark. So that's why we're saying we are better than mutual funds for an obvious sense, especially in the large cap and multi-cap space. One more question. Great platform. Thank you. How do you remain or become profitable keeping fees at 0.25%? So short answer is this. We don't have star fund managers. We don't have an army of analysts. We don't have a set of distributors we need to pay for. We essentially saying we have created a platform which does what is known to even mutual fund managers well. And our cost structure isn't anywhere near what an HDFC AMC's cost structure is, or ICICI Pru's cost structure is. Lean cost structure, use technology, which is a common gripe a lot of people have against asset management companies in the West as well as in India, that they're still living in 20th century when it comes to use of technology, alternate data, advanced machine learning models. All of that is anathema to them. So by using that, we're able to essentially bring it about here. So think of it like Zerodha versus brokers, right? When Zerodha came about, we suddenly realized that we didn't have to pay 0.5% for broking. We can just get away with now zero, but as low as 0.05 or something, 1/10. We are trying to bring about a similar revolution in the mutual fund space by saying you don't have to pay 2% or even 1% in a direct plan to have your large cap core equity portfolio managed. There you can get away with paying just 0.2, 0.25. Two questions here. How do you do allocation in large cap? We do allocation as I described. There is a tilt created on the basis of the portfolio, the factor that is in question. So if it's a value factor, then high value companies, which are low price to earnings ratio, will have greater weight, and low value companies will have lower weight. And that weight variation is added to the benchmark weight. So that varies the tilt, if you will. How long have we been active? Over how many portfolios have we tested it? We have tested it over about hundreds of portfolios. I would say closer to 450, 500 thereabouts. It's an interesting question. How long have we been active? So my quick background, I used to work, and most of my team also, we used to work with a global hedge fund called Engineers Gate. I was running the India portfolio of Engineers Gate. This is essentially equities long short. So you could think of it as a Cat 3 act, if you will. But we were doing only global money for India. And that's when we realized all these nuances of alpha, beta, and the fact that in Indian markets, alpha is overpriced, is non-existent, but still overpriced. And so all our algorithms have been designed over last 4 years, 2016 to 19, have been live in a long short form since 2018 itself, and in the long only form for last year or so, approximately. Then, how does the rebalancing take place? After 3 months, some stocks are excluded or have their weights reduced. Can we sell directly to the platform or replace with a new portfolio? When we give out a rebalancing trigger, we'll give you the trades, not the new portfolio. You can see the new portfolio also, but that's more for your reference. It's essentially saying we told you to buy, say, 7 lakh worth stocks when you told us create a smart beta portfolio for you. You did that, 6,95,000 stocks worth were bought. They've grown to some other value now, say 7,30,000. Now you have, say, 3 of Castrol and 4 of Eicher Motors and so on and so forth. We'll give you a delta, which is carry out these trades, which is sell 1 of Castrol and buy 3 of Infosys and so on, just the variation. And when you okay that, you don't buy the whole portfolio anymore. You just make the delta orders happen through the same mechanism I showed. So it's a one-click process if you carry it out. You can carry it out independently also, but we recommend that you do it through our system so that it remains on track. It remains precise. Let's see, some stocks excluded. You said that you will outperform MS by 3 to 4 percentage points. Will the 3 to 4% point outperformance to MFs come entirely from cost savings? How do you estimate target returns? So let me just walk you through the example one more time, and then I'll tell you where that comes from. So when I'm saying a smart beta portfolios, right? So this is my smart beta portfolio I constructed. This performance that we showed here, 12.3 versus 16.7, that's a 4 percentage point outperformance. Let's assume that our fees is taken out 0.25% per annum. So 16.7 becomes 16.5. Let's call it 16.3 for rounding. So it's 4 percentage points better than benchmark. Even if mutual fund is 2 percentage points better than benchmark, we're still 2 percentage points better than mutual fund itself. So 2% comes from that, but we're not even counting that entire 2. We're saying 1 to 2% will come from that. Mutual fund charges either 1% in direct plans and 2% in regular plans. We charge 0.25, so 1 to 1.5 percentage points saving on the cost. Tax, which I'll talk about after this round of questions. We will help you save uh, almost all of your cap gains tax on equities through extremely advanced algorithms that we have built over the last few years called tax loss harvesting, completely legitimate, completely compliant with the local laws. And they are done essentially by UHNIs in the West, advised by Goldman and Morgan and so on. We're democratizing that and making sure that you get almost no tax liability, which means on the cap gains front, on equities, that is, which means you'll save about, given that long-term cap gains tax is 10%, you'll save about 1 to 1.5% from that as well. So of our 3 to 5% point outperformance versus mutual funds, almost 3 percentage points come from just cost and tax savings, which is certain, unlike the performance being better by about 1.5% or so. So we are not saying we'll do better than mutual funds entirely on performance count alone by 4%, because that is variable, right? Nobody can guarantee that. That part is only 1.5%, maybe 2. But 1.5 from fees saving, 1.5 from tax saving. That's the broad math. Now, so let me take these 3 questions a bit later. I'll first quickly go through the last bit, which is tax and cost. So on that front, we are essentially, on tax and cost, on tax, we are saying we're going to do another webinar for tax alone, which is called tax saving through personalized equity portfolios and so on. There are 2 ways to save tax. One, an obvious way for small portfolios, and one slightly less obvious and much more intricate for large portfolios. The small portfolio approach is that the 2018 budget, which brought in the long-term cap gains tax at 10%, also added that leeway, which is up to 1 lakh in long-term cap gains tax each year, there is no tax. And that's not limited by your portfolio size or your net worth or income or nothing. Simply up to 1 lakh cap gains, there is no tax on equities. Now, this is often overlooked by a lot of people, including me till almost last year for that matter. And it's an interesting thing because it's like 10,000 rupees for you to save every year for no real work. What it means is every year you should book 1 lakh rupees of tax in equity capital gains and reinvest in the portfolio, because that is not taxable. So you should do it, in fact, through the next month before the end of March. So that straight away saves 10,000. It doesn't come to you immediately, but when that portfolio is eventually exited, your number at which your purchasing is gone up. So your tax liability subsequent year goes down. For a 10 lakh or sub 10 lakh portfolio, this already saves cap gains fully. You don't need to do anything else, because realistically you earn 10 to 15% returns anyway. So 1 lakh each year is already taken out if you keep doing it religiously. 5 years, if you just do buy and hold and don't do this, and if you're up by 5 lakh, then you'll pay 50,000 rupee tax. But if you each year keep booking 1 lakh, then last year you'll have effectively 0 cap gains tax, because 1 lakh and last year also covered in that exemption. So that's an obvious way to save money. The more complicated way for larger portfolios, and here there is no upper limit, you can save this for even a 100 crore portfolio, is something called tax loss harvesting. We have developed algorithms which will open up to our users for additional fees, which is optional if they want to use it, for harvesting tax losses by selling loss-making stocks and buying back again. So you're not altering your portfolio, but you are generating tax losses to set off against your genuine cap gains taxes. By doing this year after year, you will be able to bring about your tax liabilities to nearly 0. Sometimes you might even be able to use this to offset your cap gains in other asset classes, which is even more advanced way of doing tax loss harvesting. But we'll come to that in a separate webinar. So let me go back to questions then. So that's one aspect of our platform, which is also live for live investors who have traded through our platform. Now, you said that's done. Is there a model portfolio in-house research team? We don't believe in model portfolios, but you can say we can create a few sample portfolios if that helps people, investors. So there is obviously a model portfolio for quality, value, trading activity, dividend yield, and so on. There is a model portfolio for ESG and so on. But we want users to actually say, it's a good starting point. Let me just modify it beyond that to my liking. And not just modify and leave it at that, but modify and see how it performs. and then decide whether I want to keep the modification or iterate on it. So in-house research team for us, we come from a quant hedge fund background. So for us, research is not about meeting managements and poring over balance sheets and P&Ls. For us, research essentially means which factors outperform which other factors. How do you vinserize outliers in a 500 stock portfolio? How do you control risk in a 50 stock or 70 stock portfolio, and so on? How do you account for sector correlations, and so on and so forth? So we are a very quantitative firm in that context. So we do have an in-house research team of 4 research developers, as we call them. Are we looking at partnership model for this platform? Yes, we are. We are talking to 2 fintech firms and 1 asset management firm also for having them use some elements of the platform. So the models are still early. We are thinking about enabling other advisors to use our platform for their clients through a separate advisor channel, if you will, which will be essentially a fee-based approach where we share fees, and that's pretty much it. How can you invest? That's a simple question, straightforward. As I said, the platform is live, so you can immediately after this presentation also go to MakeMyFund.in and just type in your preferences, create your portfolio, and register. And straight away go to execution and do it. So it can be done as I just demonstrated on the during the presentation. I made an investment right in front of all of you of whatever that 7,000-8,000 rupees was through our platform. So it's live, up and running. You can do it anytime, today, tomorrow, whenever you feel like. Now, last but not the least, there's one more point I'll make, and then we'll take the Q&A session in its entirety. What we call SIP orthodoxy is also something that we're looking to essentially overcome. What we mean by that is when you ask an MF manager or wealth advisor, is this a good time to invest? The answer is never no. And if you tell them, how should I think about investing? They'll say, just do SIPs and forget about it. That doesn't answer the question, where do I invest my lump sums, right? And there is always that constant struggle of figuring out, is this a good time to get into markets or not? And we want to answer that question. So we are creating, and we're going to go live within a day or so on that as well, which is equity program management, or being able to take cash calls using our platform, our in-house predictions based on machine learning models about where the markets are likely to be. And if you have a certain lump sum to invest, how should you programmatically invest it over the next 3 to 6 months with complete discipline, so that you don't postpone it forever, nor do you invest at a very high level, because most investors end up investing in the frenzy when everybody is very bullish, and they keep backing out when markets start to fall, which might be actually a good time to get in. So our program handles all of this, and so we're also able to tell you when to get in, not just what's the best portfolio to invest in. So that's another point, which we'll again do a separate webinar on at a later point of time. So now this is pretty much all we had in terms of introducing our platform. So thanks a lot for joining in. We'll move on to Q&A and answer all the questions as they come. So coming to that, next question now, if I understand this correctly, this is purely a customizable portfolio. If I'm not sure about factor timing or factor tilts I should make given the current environment, you will not be able to provide multi-factor portfolio to us. It's an interesting question. So in fact, one of the early users beta users did give us this feedback. And short answer is we are looking to do that. So we will provide some guidance on which factors perform well in which market environments. So some are evergreen, but yes, there are times when value doesn't do well. There are times when trading activity is a bad idea. So we will have our own in-house multi-factor portfolio also on offer, should you just wish to replicate that, or should you wish to start from that and modify it additionally. So we will have that. Slightly broader question, but what's the future of this platform? Where do you see hyper-customization investing going in the next 5 years? Well, we are very hopeful that this does become the Zerodha of the mutual fund world. So essentially, we want to replace mutual funds. we think that any savvy investor shouldn't use mutual funds for equity investing. We do believe in the bipolar world where instead of the mutual fund in the middle, we split it right there and say, on the one hand, we have these low-cost customizable platforms like ours, where you get investments for 0.25% per year. And on the other hand, you have these super focused managers who might invest in 10 stock, 15 stock portfolios of mid caps, small caps, or whatever major themes and whatever research they do, alpha seeking. So 80% of your money goes in core platforms, as we call it, satellites at 20%. Core you pay 0.2%, 0.25% for. Satellites you pay maybe 2% or profit share based things, but your net fees comes down and your performance is a lot more pinpointed in the specific alpha seeking ideas. So that's how we see the evolution of this equity investing space to be. Of course, we'll have many other platforms similar to us coming up in future as well. But all of these will occupy the left-hand side, as I think, the low-cost core equity portfolio side. Slightly broader questions. Since the portfolio is visible on the web without any charges, can there be possibilities of some investors bypassing the fees, creating portfolios for a smaller amount, replicate the same? We do think that's a possibility of gaming the system, but as you would have seen, when I created the portfolio, so my portfolio was a 50 stock portfolio when I demonstrated to you. So let me quickly show that. Where is that? Sharing here. So let me quickly walk you through how that portfolio, what was created. So this portfolio was the highest return portfolio we created next. This was your question, right? That you could see all the stocks. So then what stops me from just copying this? So firstly, you can't download it unless you are logged in. But more importantly, you can still copy it manually and then say, okay, I'll invest in the same portfolio. But look at the number of stocks here. This is closer to 40, 45, 50. And this, all you see here is percentages. So next, when you go and you create this portfolio, you essentially the CSV you download, or let's say you just go to the dashboard, demo 222. You see the number of stocks here is much smaller because I just invested 10,000 rupees, right? The point I'm trying to make is that if an investor is so averse to paying 0.25% of fees, so even at 10 lakh rupees, it's a 2,500 rupee fees. If they're so averse to paying that and willing to take the risk that the portfolio that they will create on their own will be suboptimal because they would be creating percent-based portfolios at their end, which may not be optimal. That's the first point. Second point is we're not going to send them rebalancing triggers. If you stop at this point where you just downloaded the portfolio and didn't do anything else, you downloaded this portfolio and said, okay, I'm happy enough with this. I don't want to log in or anything. Now, when this portfolio changes after 3 months or 1.5, 2 months, end of March, you're not going to get a trigger from us because we don't even know that you have this portfolio. So we only create triggers for these portfolios. So this portfolio, of course, will have a rebalancing date, right? This rebalancing. On 31st March, this will get rebalanced. You'll get a trigger. So you have to modify that. So that answers the first question. But the second question is still valid, which is I may do a paper portfolio like this, which doesn't cost anything. And for my live portfolio, I'll just say, okay, this is what you're doing. I'll go and replicate that. Or I'll go ahead and do it myself. Short answer is that will remain as a risk. We're okay with that. If we believe that this becomes the primary model of people using it, then we'll start charging for paper portfolios. But we believe that the value addition from the actual live tracking, etc., is big enough for people to not try to game the system needlessly. Will the cost of multi-factor portfolio same or higher? It will be the same. So we won't, all these things like multi-factor portfolio are value addition, except for tax and program management, which are specialized optional things. The rest of it will be the same. It will not cost more. Would you be creating a historical dashboard with reference to how each factor has performed under different market cycles? That will be useful to for users. So thanks for the suggestion. We will take this up. We'll create a separate intelligence section. In this, we'll put all of this historical performance of not only the factors, but also ESG or specific goal-based portfolios we created. Will there be additional risk controls to keep drawdowns in check since the preference is for high karma portfolio? Short answer is we believe that our program management should take care of that. So we think that our nifty prediction models, which we already run currently and are in public domain without any fees, so those would also be implemented in our program management logic. So people following our program management should generally be able to withstand drawdowns. But yeah, should a COVID-like thing happen, I would be surprised if anyone, including us, be able to forecast something of that sort. Short of that, we don't believe that we should sort of over time the market beyond a point. Entry is fine, but exposure management is something which is slightly more nuanced. So we want to educate investors on that, but that's under the program management ambit. Do you advise exit or shift in debt fund? Yeah, of course. We have a separate fund, separate portfolio called, so let me just type out the names here. Kaustav, you can just type this out if you can hear me. We have a product called Fund Sage, which is exclusively focused on debt mutual funds and how credit risk is, just put the link also, Kaustav, how the credit risk is completely misunderstood by over-relying on credit ratings alone. So our machine learning models actually find out the true credit risk of companies and then build up from bottom the mutual fund level credit risk and also interest rate risk and liquidity risk, and give a score for investability in each debt mutual fund, and not only a score but also variation in it, which we track through a separate product called Hawkeye. So of course we do that in debt. Derivatives we are currently staying away from. So there is a question on derivatives. Our primary work till 2018 was in derivatives, and we still run a hedge fund for overseas investors. But the Indian context, the taxes take away a lot of the upside, and trading is best restricted to sort of savvier investors. So we may launch a derivative strategy in future within MakeMyFund, but for more discerning investors who are okay with the risks of it. It's obviously inherently risky because of the leverage. How long the advice in stock? I guess I didn't quite understand the question fully, but our holding period for stocks is closer to 1 year plus. So each stock, we don't do a stock level advisory really, but each factor has its own pluses and minuses for stocks, which shift fairly slowly. So if you're a high ROE stock, you're not going to become low ROE in 1 month. If you're a high trading activity stock, you will remain so for at least a couple of quarters. So it's fairly slow moving. How many clients do we have and when did we start? So we have about 750 plus registered users for our debt platform. Equity platform is starting now. So we have we have the beta clients, which is just at the beginning. Great. Does the platform delve into portfolios with more than one quantitative strategy, for example, using a pair trading strategy? No, we don't do that at present, because there is an inherent benefit of diversification. I don't want to get into the math of this too much, but let's put it this way. If you have a certain edge in your research, your portfolio size, if it's N, then your quality of the returns, Sharpe ratio, is proportional to square root of N. So if you have 100 stock portfolios, then your edge gets multiplied 10 times, square root of 100. If you have only 2 stocks or 1 stock, your edge is multiplied only by 1.4 times. And edge generally is very hard to achieve, so it's a fairly small number. What I'm trying to get to is a 2 stock portfolio, however smartly designed, will be far riskier than a 20 stock, which itself is much riskier than a 100 stock portfolio. So we believe in keeping it very, very diversified. But yeah, if I may have misunderstood your question. So you're saying, does the platform delve into portfolio with more than one quantitative strategy? So if you'd seen in our approach, we are here essentially showing these portfolios, right? These are multiple different strategies. Each of them can be thought of as an individual quantitative strategy. We'll add more to this. So you can essentially think of it already as a 5 strategy portfolio. Great. So I think we are just approaching the 1 hour limit now. So we will close at this point. And I definitely would invite you to our subsequent. Sorry, just give me a sec. We'll invite you to our subsequent webinars on the topic of tax loss harvesting, ESG investing, smart beta investing, which will be in-depth analysis of each of these subsets of the Make My Fund platform. So look forward to seeing you all in the subsequent platforms as well. And I invite you to check out MakeMyFund.in and try out various portfolios, small, large, paper, live. Give us feedback. It helps us become better. And we look forward to having all of you as our clients. Thank you so much for participating, and thanks for taking the time. Goodbye.